In very simple terms, the market is starting to price a pickup in economic activity and is justified in doing so. As we've just heard, the growth rate of the COVID-19 cases across the continent and also in the US is slowing. Governments have started to open up, and as a consequence, we can see on the high frequency gauges of economic activity that activity has troughed in the middle of April and is now picking up. And the most important determinant of the direction of equity markets is the question of whether activity is slowing or whether it's picking up. If we've just seen the trough, if we just have entered the recovery phase, then equities are responding correctly to this, and then they've got further to go.
The news of that early trial around a vaccine certainly stealing the headlines this morning. But what about the initiatives by Germany and France to come up with a recovery fund? There was a feeling at one stage by some investors that maybe Europe would be left behind with the muddling through to come up with a rescue fund, while the Americans came up with plenty of cash. What do you make of this initiative, a €500 billion recovery fund that still needs approval from the rest of Europe?
I would think about the market situation in two ways. The first one is, which I think is the core question that I've just pointed to, which is the question, what is happening to growth momentum and what will happen to growth momentum over the next 3 months? And there, this recovery fund, while it's important for the longer term outlook, is not going to have a bearing on the growth momentum in the near term of the next quarter or so. So what I would think about first, what impacts the growth picture and what is happening there? And there the news are very favorable. You're easing the lockdowns, activity is coming back, and that has further to go. And the second question is, are there any tail risk? Is there anything that could derail this recovery? And one thing that certainly could happen is market doubts about Italian sovereign debt sustainability. And clearly, if we have more mutualization, more willingness by the euro area partners to aid one another, that reduces that secondary risk. But I would say for now, what the markets are pricing is this primary narrative, which is you have seen a tremendous deceleration in the economy, but that has just come to an end, and you're just inflecting positively on the growth front. And if you look at equity markets over the last 10 years, last 20 years, that by far is the most important signal. And then I would make one more point, is the most interesting analogy to look at the current situation is the trough of the market in 2008, 2009. And then we saw exactly the same pattern. The moment that growth momentum troughed and started to accelerate, you had the shift in sector leadership and you had the shift and a change of direction in the overall market.